Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so Bob's asking, would you go 3 months out on currency option contracts? So Bob, I try to match my expiration to what's the duration I expect to be in this trade. So do I, I mean, ultimately we're always kind of guessing. We can't predict the future, right? So we make some estimates. And I like to err on the side of buying, more time than less time. So, I think in general, 60 to 90 days is sufficient. But if you're trying to take advantage of a very long, more macro move in the currency market, so let's say, for example, that you think, so let's project ourselves a little bit into the future. Let's say that, finally things settle down in Europe, right? And economic growth globally starts to look a little bit better. And all of a sudden, traders start getting nervous about inflation for the U.S. dollar. But, but we don't know when it might happen or how long it might take to happen. And so we want to buy an option that would be in play over the next year or 2 years. So that whenever the inflation problem finally emerges in the U.S., which I think it's reasonable to assume that it'll eventually appear, we're in a position already to short the dollar. So we've kind of bought time to accommodate the length of our trade. Whereas, here I'm looking at EUU and I'm thinking about some of the immediate problems that we're dealing with in Europe that are, if we're going to get bad news out of Europe, we're probably going to get it in the next, it could be days. We could get it this week or in the next couple of weeks. We're going to continue to see developments happening in real time. It's not quite as uncertain as trying to forecast, inflation in the U.S., which could happen a year from now. Okay, so Carlos is asking to hedge a mini lot. Okay, so if you're trading Forex in the spot market, you can, two common contract sizes are 100K, a full-size lot, or 10K, a mini lot, a tenth that size. That's 10,000 units of whatever the base currency is. And so the option contracts are, they're more or less the equivalent of a mini lot, of a 10K lot. So if you were to, let's say you were long the euro, but you wanted to sell a call against that long position in the currency options, you could do that. If you were long 2 mini contracts, then you may sell, 2 contracts worth of EUU. That would be how you would kind of make that equivalent. If you wanted to hedge 1-for-1, so if you wanted to if you were long the euro dollar in the spot market and you wanted to buy an option that would protect you 100% right from day one to any downside, you'd have to go pretty far in the money until you get those deltas that would really provide you that coverage. So we'd be getting closer to that in the money option we were talking about on the pound earlier. So I hope that answered your question, Carlos. But one thing I just wanted to make clear is that when you're looking, if you're experienced in the Forex market, you're familiar with thinking about things in a 100K lot or 10K lot, and these options are, you'd be thinking about them in the equivalent of a 10K lot. So if you were doing covered calls or covered puts or something like that, it'd be 1-for-1. Okay, so TJ is asking, any benefits to options on underlyings that trade in penny increments? TJ, I'm not sure I understand your question completely. Could you maybe clarify? Give me a for instance. In the meantime, if anybody has any questions. So, okay. So TJ, let me restate your question, all right? Any benefits to options on underlyings that trade in penny increments like the SPY? So, so I assume the spread between the bid and the ask of, a penny or 2 pennies or something like that. Is there any benefit to options? I mean, clearly the tighter the spread is, that's always in your favor. As retail traders, we like tight spreads. And, sometimes we're willing to give up a really, really tight spread, a penny spread or a 2 penny spread in order to get access to, a specific asset class, like currency options, for example. The spread's not typically a penny wide, but it gets, tighter over time as liquidity continues to improve. I think generically speaking, you can always say that, the tighter the spread, that's going to be to your advantage. And the tighter the spread gets, in currency options, that's going to be all the better for retail traders, for sure. Okay, so Bob's asking another question here. On credit spreads, would you use 2 standard deviation strike prices? So so Bob, can I restate your question? Could I maybe suggest that you're asking whether you should set strike prices on a credit spread, so a vertical spread, equal to, let's say, the bandwidth on a Bollinger Bands study? Would that be accurate? Okay. I think that's reasonable. Sometimes those Bollinger Bands are going to get real tight when the market's a lot softer. So I tend to stick with the idea that since we can't predict the market with a great deal of accuracy, we can make some estimates, and I think lots of times we can get really close. But since we can't get hyper accurate, I tend to kind of fall into the school of thought that it's better to just be consistent all the time. So when I'm evaluating so speaking for myself, just myself here, when I'm looking at trades, at credit or debit spreads on, currency options, I tend to just opt for the $5 spread, between the strike prices as just something that I do every time, because I can't get real fine point on predicting the market to the level that I feel like it would be worth it to modify those widths all the time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.